Did you know that 63% of Americans have less than $500 saved for an emergency? Or that nearly 70% of people over 50 have less than $100,000 saved for retirement? These shocking numbers show how many people struggle with financial security, even as they get older. But what if there was a way to break free from this cycle and build real wealth, like the rich do? In this video, we're diving into the powerful world of value investing, a strategy that's helped the world's wealthiest individuals grow their fortunes. Forget about risky day trading or following the latest stock tips. Value investing is all about finding solid, undervalued assets that have long-term potential. We'll explore how Robert Kiyosaki's mindset from Rich Dad Poor Dad can change the way you approach money. You'll learn how to find hidden gems in the market, how to manage risk like a pro, and why patience is your secret weapon to wealth. Stay with us, because by the end of this video, you'll have the tools to start making smarter investments, no matter your experience level. Get ready to unlock the secrets to financial freedom. Chapter 1. The Mindset Shift. From consumer to investor in Rich Dad Poor Dad, Robert Kiyosaki emphasizes a simple but profound idea. To build wealth, you need to think like an investor, not a consumer. Most people spend their lives buying things they don't need, which keeps them stuck in the rat race. But the key to financial freedom is shifting your mindset from spending to investing. Kiyosaki argues that the rich focus on acquiring assets that generate income. This is the essence of value investing. A key strategy for value investors is to stop relying solely on a paycheck. The average American spends about 70% of their income on basic living expenses, according to the U.S. Bureau of Labor Statistics. Instead, consider every dollar you earn as a potential investment. When you shift your mindset, you start to view money as a tool for creating more wealth, not just paying bills. Value investing, as Kiyosaki might suggest, starts with understanding that it's not about making quick gains, but finding long-term opportunities. It's about buying undervalued assets and holding onto them for the future. Warren Buffett, one of the most famous value investors, once said, "The stock market is a device for transferring money from the impatient to the patient." Patience is key, and it's this mindset that sets successful investors apart from the rest. You also have to start seeing risk differently. Most people avoid investing because they're afraid of losing money. However, Kiyosaki stresses that avoiding risk altogether is the real danger. In value investing, you learn to assess risk, not avoid it. Understanding financial statements and market trends helps mitigate risk. With the right knowledge, you can buy assets at a price lower than their intrinsic value, giving you a safety net. It's not just about the mindset, it's also about the environment you create. Surround yourself with people who understand wealth-building principles, just as Kiyosaki did with his Rich Dad. This community will keep you motivated and inspired as you learn to invest. Chapter 2. The Power of Financial Education. Understanding the Game. Kiyosaki argues that financial education is essential to success. According to a 2021 study by the National Financial Educators Council, 60% of Americans report feeling stressed about their finances. But, in reality, most financial problems come from a lack of financial knowledge. The good news? You can change that. The first step is understanding the basics of investing, including how to analyze financial statements, such as balance sheets, income statements, and cash flow statements. These documents are essential for value investors because they show a company's true health, not just its stock price. Kiyosaki recommends focusing on companies that have strong fundamentals, such as consistent profits, low debt, and a competitive edge in the market. Value investors also understand that market prices don't always reflect a company's true value. The market often overreacts to news, creating buying opportunities for savvy investors. For example, during the 2008 financial crisis, many solid companies saw their stock prices drop drastically, only to recover in the years that followed. Kiyosaki believes that financially educated investors can capitalize on these market fluctuations. Buffett's famous strategy of buying low and selling high is all about understanding market cycles. This isn't a gamble, it's a calculated move based on your research. By investing in undervalued companies, you are buying into solid businesses that the market has temporarily misunderstood or overlooked. But financial education doesn't stop at just reading books. Kiyosaki advises actively learning from real-world experiences. Whether through stocks, real estate, or businesses, each investment teaches you something new. The more you learn, the more you become comfortable with making financial decisions. Chapter 3. The Value of Value Investing. Finding hidden gems. Value investing is about finding diamonds in the rough, assets that are undervalued by the market. As Kiyosaki notes, the rich aren't necessarily the ones who have the most money. Instead, they are the ones who know how to find value where others don't. For example, if a company's stock price falls because of a temporary setback, it doesn't always mean the company is a bad investment. Often, it's an opportunity for value investors. One strategy to find hidden gems is to look for companies that have a strong balance sheet, solid cash flow, and are trading for less than their true worth. A company's intrinsic value, calculated through methods like discounted cash flow analysis, can provide a clearer picture of its potential. According to a report by the CFA Institute, value investing strategies have outperformed growth strategies over long periods, proving the power of finding undervalued stocks. A key part of value investing is the ability to look beyond headlines and market sentiment. The market can be emotional, and many investors panic when stocks drop. But a smart value investor sees this as an opportunity to buy shares at a discounted price. When others are fearful, value investors are courageous. This is why Kiyosaki believes that financial education helps you stay calm when the market is volatile. An interesting fact: in the first quarter of 2020, the stock market dropped over 30% due to the pandemic. But by 2021, many of those stocks had fully recovered, and some even thrived. Those who understood value investing principles took advantage of this opportunity, acquiring stocks at bargain prices. You should also pay attention to the management and leadership of the company. Strong, ethical leadership is often a good indicator of long-term success. Kiyosaki himself often talks about the importance of understanding the people behind an investment, not just the numbers. A great management team can navigate market downturns and capitalize on new opportunities, making them invaluable for long-term investors. Value investing requires patience, persistence, and a keen eye for opportunities. It's not about following the latest trends but making decisions based on facts. By applying these strategies and being diligent in your research, you can uncover opportunities that others might overlook, paving the way for wealth building over time. Subscribe now before we move to the next chapters. Make sure you hit the subscribe button below. That way, you won't miss any valuable tips on how to build your wealth with smart investing strategies. Chapter 4. Risk versus Reward. Calculating the safe bet in Rich Dad Poor Dad. Robert Kiyosaki often talks about the importance of understanding and managing risk. One of the main principles of value investing is learning to take calculated risks, not avoid them altogether. Many people are afraid of investing because they think it's all about risking money. However, risk management is about making educated decisions based on solid research. Kiyosaki advises that risk isn't about gambling, it's about understanding what you're investing in. Value investors use data, financial statements, and historical performance to assess whether an asset is worth the risk. Warren Buffett often says, "Risk comes from not knowing what you're doing." This rings true for anyone looking to build wealth through investing. A key strategy for managing risk is to focus on the margin of safety. This means buying an asset for less than its intrinsic value. By doing so, you reduce the likelihood of significant losses if the market fluctuates. For example, if you buy a stock that's priced well below its actual worth, even if the market drops, you still have room to avoid big losses. Let's consider the 2008 financial crisis. Investors who stuck to value investing principles were able to scoop up stocks at a fraction of their original price. These companies, once the market recovered, saw their stock prices rise significantly. Those who weren't prepared for the risk, or the opportunity, missed out on long-term gains. The power of the margin of safety lies in the fact that it's a buffer. It helps protect your investment when things don't go as planned. It also emphasizes the importance of patience. Instead of rushing into risky investments, value investors wait for the right opportunities where the risk is manageable, but the reward is high. A study by Vanguard shows that value stocks, over long periods, generally outperform growth stocks in terms of risk-adjusted returns. This highlights why value investors focus on finding bargains, stocks that have the potential to recover and provide significant returns, even if they experience short-term dips. Chapter 5. Patience Pays. The art of waiting for the right moment. One of the most powerful lessons in Rich Dad Poor Dad is the idea that wealth takes time to build. Kiyosaki repeatedly emphasizes that patience is crucial for long-term success. This is especially true in value investing, where investors must wait for the market to recognize the true value of a company. Buffett, a master of value investing, famously said, "The stock market is a device for transferring money from the impatient to the patient." This means that those who act quickly without considering the long-term picture may miss the bigger rewards. Value investors, however, understand that buying a great stock and holding onto it for years can result in significant wealth. Patience is a key strategy in value investing. The best investors aren't swayed by market noise or daily fluctuations. Instead, they focus on companies with strong fundamentals and wait for the market to catch up. Take, for example, Buffett's investment in Coca-Cola. He saw the long-term potential of the brand in the 1980s, and even though the stock price took time to rise, he patiently held on. Decades later, it paid off big. Investing with patience also requires emotional control. Many investors get anxious when their investments don't immediately rise in value. This is where Kiyosaki's advice on financial education becomes critical. When you understand what you're investing in, you're less likely to react impulsively when the market experiences volatility. Furthermore, the strategy of buying undervalued stocks and holding them over time helps investors tap into the power of compounding. The longer you hold onto an investment, the more it has the chance to grow. Albert Einstein famously called compound interest the eighth wonder of the world, and it's a key factor in long-term wealth accumulation. It's also important to note that markets are cyclical. While the short-term outlook can be rocky, long-term investors can ride out these cycles. According to a 2022 study by J.P. Morgan, the average annual return of the S&P 500 index from 1950 to 2020 was around 7.6%, even after factoring in inflation. This underscores the power of patience and long-term thinking. Subscribe now if you're finding this valuable. Hit subscribe now. You'll want to stick around for the final steps to mastering the value investing game. Chapter 6. Building Wealth. The Roadmap to Financial Freedom. The final step in applying Kiyosaki's principles to value investing is building a roadmap for financial freedom. Kiyosaki teaches that the key to wealth is to build multiple streams of income. Value investing fits perfectly into this philosophy. By carefully selecting undervalued assets, you can create a portfolio that generates consistent returns over time. One of the first strategies for building wealth through value investing is to start small. Don't rush into buying high-priced stocks. Instead, begin with companies you understand, and build your portfolio gradually. As Kiyosaki notes, start where you are, with what you have. This applies to investing as well. Even small investments can grow into substantial wealth if you follow value investing principles. Diversification is another critical part of Kiyosaki's wealth-building strategy. Just as Kiyosaki advises investing in both real estate and businesses, value investors benefit from diversifying their portfolios. A mix of stocks, bonds, and real estate can help protect you from market volatility. By holding a variety of undervalued assets, you create a more stable foundation for future growth. One of the key aspects of value investing is that it doesn't require constant trading. This means you can focus on acquiring high-quality, undervalued assets and let them grow over time. In Rich Dad Poor Dad, Kiyosaki stresses that wealth building is a marathon, not a sprint. Instead of jumping from one trend to another, you stick with what works. Real estate is another area where Kiyosaki emphasizes the power of value investing. Just like in the stock market, finding undervalued properties can lead to long-term financial success. For example, during the 2008 housing crisis, many investors bought real estate at significantly lower prices, and when the market recovered, those investments soared. Building wealth also requires understanding tax advantages. Kiyosaki notes that the rich take advantage of tax laws to protect and grow their wealth. For value investors, understanding how taxes impact your returns is crucial. Capital gains taxes, for instance, can significantly affect your profits if you don't plan ahead. Finally, Kiyosaki emphasizes that financial freedom comes from taking action. Value investing is not just about reading books and learning theories, It's about making informed decisions and executing a well-thought-out plan. As Kiyosaki puts it, the only difference between a rich person and a poor person is how they use their time. If you apply the strategies of value investing and remain patient, your roadmap to financial freedom will start to take shape. Subscribe and stay tuned. Thanks for watching. Don't forget to subscribe and turn on notifications. You won't want to miss any of the future tips and strategies to help you achieve financial freedom with value investing.